We all know this feeling. Price spikes just enough to take you out, then completely reverses as if the market is watching your stop loss. You've probably heard this one too, where people are saying that the market is being manipulated, that there's this secret algorithm designed to hunt stops and punish retail traders. But here's the truth. That story isn't just wrong, but it's also stopping you from actually understanding how the market. Most traders' beliefs move like these are engineered to target their position. They imagine a centralized algorithm kind of pulling the strings here, running stops, liquidating retail, then moving the other way. You can see in this example, we've got clear swing points right here where we believe that this high is somewhat protected after we take out some sort of structure to the downside, yet price then absolutely obliterates this swing point, taking out retail stops, engineering liquidity against retail. This theory is very compelling. It kind of gives meaning to your losses, right? And it creates this villain. It helps you feel like this victimized suspect of pretty much the market, right? But that's really not the case. Here's the truth. There really isn't a market maker sitting in his office waiting to hunt your stop loss. What you're seeing isn't necessarily manipulation. It's actually a structural process where price fulfills imbalance, not necessarily the imbalances you already may be familiar with between three candlesticks, but just in general, an imbalance in between buy side and sell side within the market dynamics. It's not necessarily reacting to you, right? That is the biggest thing we need to understand in this case. If these moves weren't designed to necessarily trap you, why do quite often enough many of these moves actually continue after that spike? So not always do you see that these runs on liquidity will be the reversals, right? Often enough, you will see that these spikes, these traps on retail traders, the ones where you believe that you are victimized, they actually continue. They continue distributing liquidity in the direction that it needs. So not every run on liquidity will be a trap, whether that's buy side or sell side, a bullish or bearish trap. In this case, what we see here is actually a run on all this sell side liquidity overlapping with many higher time frame arrays, giving some sort of feedback, but then actually just continuing lower. This was a trade that I took. I lost in this trade, but I was very much aware of the risk taking this. But what happened here is the market, it's doing what it has to do in order to execute size in a fragmented, decentralized system. In this case, what we notice is that there was enough sell-side liquidity resting below actually that price then decided to deliver into. This was led by technical arrays such as imbalances, order blocks, and inducements to the downside, where price kept respecting these bearish arrays rather than reversing and creating bullish arrays near our anticipated levels. All in all, it's a totally new dynamic where you understand that the run on liquidity isn't always a trap where price will reverse and then flip sides, making you feel like some sort of victim. It's safe to conclude that these liquidity runs aren't personal. They're not about punishing you or retail traders. Neither are they a tool that institutions use to target and gather pretty much these bundled liquidity, whether that's an aggregator or liquidity provider. These liquidity runs are about fulfilling intent, and that may be a word you are already familiar with. Intent in the form that you see imbalances being created, and we will cover the concept of imbalances with candlestick charts. You may know them as FVGs, fair value gaps. We will debunk that concept as well because they're not there's not always necessarily fair value guaranteed in these gaps. So imbalances is something that we'll cover later. But in essence, what this is about is that it's fulfilling intent. Let's take an example, right? You see bearish sell side inefficiencies being left behind. So lots of imbalances, these 3 candlesticks leaving behind these gaps. Now you have to ask yourself, this entire move downwards is a displacement. Price is displacing to the downside. If these liquidity runs and you kind of want to enter off of this run or this sweep, we don't go into those details just yet, and you see that price is leaving behind sell side intentions for it to move lower, you know that what is happening here is that price is seeking counterparties, right? So we're completing transactions in a system where liquidity isn't always available. And that is when we create these inefficiencies, these imbalances. And once you understand this, you will stop fearing these liquidity runs and you will start using them as signals to understand what will happen next. So if liquidity runs aren't traps, what really are they? They're structural. They're a necessity required that the market uses in order to execute size and large volume. So when we think of, let's say, institutions, they will need large volume that they can't always execute right now at the current price point. That is exactly why they need liquidity, and liquidity isn't everywhere. So what we kind of notice is that liquidity tends to cluster around obvious places, right? Swing highs, swing lows, and session opens, which are the ones which contain the most amount of volume. Think of London and think of New York. Also session closes when London tends to close. Overlaps, stock exchange open, equity opens, all that good stuff. Around recent highs, you will kind of start to realize that there are one of two things. There are stop orders, buy orders, limit orders, all waiting there. These aren't really the terms that you and I actually will be using in the institutional side of things. Think of stuff like OCO, iceberg, and ghost orders are kind of the stuff that you may be familiar with in the future space of things when you are encountered with price ladders. Overall, let's kind of dumb this down a little bit and let's try to kind of relate this a little bit to supply and demand. So above these relatively easy and identified areas is where price is considered either cheap or expensive. The exchange of that currency is considered cheap or expensive. In this case, above these recent highs, above these recent lows, you will notice that there is what we call passive liquidity. Passive liquidity is usually when there's a pocket of passive liquidity. When institutions want to run price into these zones, it's not as if they're trying to punish you, but what they're doing is seeking counterparties, people on the other side of their trade. So let's take this, for example. Let's kind of take this structure, what we see here. You can see very nicely how price creates areas where it will be considered expensive, such in this case, right above this two equal highs, relatively equal highs, you will understand that price actually is deemed to be relatively expensive. The increase for the dollar will be increased around these highs, whereas below these lows, purely based off just the information that we see here, you will notice that there will be a relatively increase in demand for the euro, right? Because the exchange is considered cheap. What you notice is that this will then kind of overlap into the next day. Price has created these two swing points right here, all that resting liquidity above Asia high. But right here, you will notice that many people trading pure ALS strategies, Asia liquidity sweep, will get finessed. You know, they'll be on the M15, they'll go into M2, M3, they'll try to trade this FVG right here, and then just like that, they'll get finessed. Price then actually seeks the liquidity it needs. We've created that collection right here, and then from there, price then finds fulfillment in, let's say, an inefficiency and an imbalance as such. And then you will see that it will displace and then it will fulfill at another area where price was previously deemed cheap. So if we kind of fine tune that just a little bit, you will notice that it will be at that low. So start kind of figuring out, creating that narrative together with your understanding of liquidity, logic such as supply and demand, where price is considered expensive, where price is considered cheap. So the exchange, in this case, the exchange of the euro versus the dollar. And then understand that price is fragmented, right? If we are collecting, if we are doing a collection phase right here, you will notice that we've collected, price is transactable, it's quite liquid. Even though we've left a small, minute imbalance here, overall, we're not displacing. What do you notice? We've created this huge inefficiency right here prior to the market close the day before. And you will notice that price will have to go higher, collect new liquidity. So we're collecting here, we've displaced higher. Price is then in a previous inefficiency. It will then distribute liquidity. It has found counterparties above these highs, as mentioned, right? So that entails that it can offload inventory. And then from there, you will see that price will then continue lower. So you can see a little bit of liquid price action, and then you will see it stagger, create inefficiencies lower, and then fill in this imbalance that it left behind prior. And once you start kind of creating just that thin threaded line between your narrative and the technical terminology you may already be familiar with from SMC, ICT, smart money concepts, you will realize that that refinement and kind of creating that external story, which is actually backed by logic and the actual framework of market dynamics, you will create a much more clairvoyant approach to understanding the market and navigating the intricacies of this playing field. So this process is pretty much mechanical, right? When the market orders overwhelm the passive liquidity that there is on the chart, you will see that displacement. Price displaces and it needs to displace into the next zone where liquidity exists. That is the spike that you see. It's not a trap, it's a structural adjustment. So often enough, the best case scenarios is where that spike, that run on liquidity, so we're not distinguishing between a run and a sweep of liquidity just yet, determined by body closes of that candle. We are purely looking at that displacement where price will run a swing high or a swing low, and it will then displace into some sort of pocket. Those are the most ideal scenarios because then you can kind of take 1 and 2 together. You can understand that the collection phase where price has been accumulating, collection has been fulfilled. So the market participants that wanted to move price above these swing high points are able to have distributed and offloaded their inventory. Likewise, from that pocket, you will then want to see some sort of realignment, some sort of opposing liquidity being created in the form of structural imbalances to the downside, showcasing that new market participants have stepped in the opposing direction. So it's never really a trap. It's a readjustment that aligns better with the higher time frame narrative. So watch this sequence right here. What we notice is very, very classic examples, right? What we notice here is price consolidates in this area right here. It is building up kind of that buy-side pressure. From here, we have that displacement, right? This displacement then took place into a higher time frame array. In this case, it was our weekly imbalance, this open pocket, transacting above that distal line of that weekly imbalance. Once we have that, it surges this high, right? The high that we have here sweeps all that resting liquidity. So we're running that liquidity and you can see that it stabilizes right here. It's not random. It happens over and over again. It's the market resolving an imbalance and completing transactions. From there, we have the fulfillment, which is price returning back to the original structure that it left behind. In this case, it's not the most clear, obvious pattern when it comes to leaving behind huge imbalances, but you will notice it, right? The thing is, you have an arsenal of arrays that you may be familiar with, order blocks, imbalances. Those are quite easily the two most dynamic ways of identifying whether or not price is building up some sort of intention to go in a certain direction. If we are creating opposing transactions, creating order blocks, it entails that there's also completion of transactions happening at that level, allowing there to be some sort of pressure to be taken out in a direction. In this case, we have that in the upside, where we see that price displaces, taking out all the resting liquidity above, and then going back into a state of liquid price action, very transactable, and then finding fulfillment and returning back to original structure. Okay, so bear with me. We're going to go over pretty much the execution flow, what happens when it comes to institutions and executions, right? Prime brokers will act as the middleman for hedge funds and asset managers. When a fund wants to buy or sell a large position, their prime broker will split that order into smaller pieces and routes them across multiple venues. This is where platforms like CME, ICE, EBS, or single bank platforms will come into place. They will do so in order to avoid moving the market too aggressively, right? So that's one end of the spectrum. This will then be done on numerous different platforms or numerous different venues with numerous different strategies, whether that's TWAP algorithms, VWAP algorithms, or iceberg orders, OCO, ghost, manual execution. That's pretty much up to how their strategy is, what their way of approaching the market is. Long term, we don't know what the goal is. We don't know how they're executing on what time frame. You can obviously view different fact sheets of these of funds and asset managers, the big players. You get that just like how you and I have a strategy, the bigger players have a strategy as well, and they will use these venues to allocate these strategies in a different varied manner with numerous amounts of risks and whatever. You get that. These algorithms, right, are programmed to find areas where there's enough liquidity to fill their orders without causing slippage. So as much as you can have some sort of manual strategy, you will also have some sort of execution flow to make sure that you get executed at the prices which you want according to the strategy you have implemented. On the other side of things, we have market makers, right? These are people that manage their own liquidity and their own risk exposure. They can be contracted to provide liquidity or not. These market makers, they fill large orders, and sometimes they will push price into areas where resting orders are clustered, like above recent highs, recent lows, because that's where they will find enough willing counter participants to distribute, to sell to, or to buy from when it happens to go above or below certain aspects of your exchange, of your price, of your graph. So when you see a sharp move and a sharp price in price, it's not an invisible algorithm that's trading or targeting your stop loss. It's the result of pretty much all these real players managing flow, using the market's liquidity, using these pockets to execute their trades efficiently. So let me just break that down one more time for you. In markets like Forex, you got to understand there's not a single data feed that runs price. Liquidity will be fragmented across all these different venues, such as CME, EBS, ICE, Reuters, LMAX, you name it. Each venue then has its own order book. And its own participants and its own internal matching logic. All these different things are completely like individual on its own counterparty, right? This fragmentation means that when large players need to execute size, they often encounter pockets of thin liquidity, zones where counterparties will be sparse, right? You will notice that if you've traded on DOMs, on CME, if you've got level 2 data feeds, that sometimes you will notice that there are areas where just there aren't enough counterparties on the bid side if you are asking, or vice versa on the ask side if you are bidding. A liquidity run happens when these execution engines push price into these pockets to complete transactions. So it's not a hunt, right? It's usually often where liquidity will be thin, but there's a reason why liquidity will be thin there, because it could have been a previous imbalance at those areas, a previous inefficiency that was left behind. So here we are going to really double down on this concept, because it's the most important aspect of understanding liquidity. You have to understand there's party A. These can be hedge funds or central banks. They want to route their orders through party B, which is the prime brokers. So there's a demand that party A wants, they will route it through party B, and party B will then execute this, and they will fragment that order flow through these venues, not to meet a different demand than what party A wanted, but to make it as efficient as possible without affecting price, right? Without making a disparity between the volatility and price, right? So they will use algorithms like TWAP, VWAP, or stuff like iceberg orders to make sure that happens efficiently without moving price as much. These algorithms are not designated to move price. So again, there's a demand, a need that party A wants. They want a certain price with a certain amount of volume. They will route it through party B. Party B will route it through numerous different venues using algorithms, but that algorithm isn't on its own designated to move price. But you can encounter moments of thin liquidity, such as holiday times, right? When the books are thinner, or right in sessions when the market just opens, right? When the desks aren't open yet and people aren't trading yet. Price will have to move to find enough counterparties, and that is exactly at those areas of resting liquidity. So here's another just clean example. Don't even need to heavily annotate it. So let's walk by it one more time. This is why price will often spike into obvious zones that are deemed to be quite obvious, because that's where pending orders are pretty much clustered. Not because the market is hunting your stop, which is above swing high in this case, but because there's resting liquidity above these areas, and if price is displacing in a rapid manner, it will go to these areas to make sure that it can find enough counterparties to seek fulfillment. So stop losses, take profits, and passive limit orders will create a liquidity pocket, and these market orders from execution engines will consume all that liquidity, causing a rapid displacement. Prime example is exactly this. We leave behind an imbalance, a bullish imbalance in this case. We've been collecting during Asia and the late PM hours, pretty much of the day before. We displace, we find fulfillment, and we go back to our original market structure. We are tapping a little bit in this imbalance, but then again, there's not enough intent to move lower. So what does price do? You can see that most likely market making capable participants are leaving the market, thinning out the books, and allowing new participants to push price higher above all these highs. Why? Because that's where there's enough resting liquidity for these buy-side market participants to distribute, and for sell side to then eventually kick in to fill that imbalance that was created in the morning. You see how there's some sort of narration. The goal for you is to identify where these runs will occur, when a run has occurred, and pretty much what will happen afterwards. So in the literature terms of things, this is described as a structural imbalance resolution. You have to understand the market isn't malicious. It's not out there to hunt you, nor is it out there to hunt me. It's a decentralized system matching flow across thousands of participants, all with their own objectives. It's still a ball game between these institutions, not between you and I, not that we're in the same Discord server and I've got a long and you've got a short and it's my liquidity against yours. No, it's a grander scheme of things occurring. So liquidity runs are simply how this system fulfills these large scale executions. So stop thinking of liquidity runs as traps, right? They're not traps. They're not here to trap you. They're not here to trap me. Start seeing them as footprints. When we have taken out a high or a low that is seemed quite obvious, start seeing what type of intent occurs after that. It's visible traces of institutional intent. And in the next video, I will go over exactly how we can recognize these conditions in real time to make sure that you can then apply them to your CFD chart. But I hope that we've given some sort of structural framework basis as to what it means when there's a run on liquidity and debunking a couple myths in the process. So have a good one, and I'll see you in the next one.